Okay, so material, here I am keeping it blank. Material usage variance, when there is scarce material, I am keeping it blank. Now next is what? Labor. Okay, labor efficiency variance. When material is a limiting factor, there won't be impact on labor efficiency variance. So here it will be 3200 adverse, so negative. But here scarce labor is there, so you have to do some adjustment. And here 3200 adverse. Now variable overhead variance. One is expenditure. Variable overhead expenditure variance. What was the amount? Variable overhead expenditure 3600 favorable. 3600 favorable in all the three cases. Because any opportunity cost, it will not have any impact on this. Then variable overhead variance volume or efficiency. Volume or efficiency. Basically it is efficiency. Okay, volume is mainly for FOH. VOH efficiency 4800 negative. No impact. Okay, here also 4800 negative. Okay, then what about FOH variances? You can't consider because it is not considered as it is marginal costing. Okay, right. Now what do you have to do? The net result should be actual profit. Actual profit. But for purpose of computing actual profit, you require what? Opportunity cost. So you can write the heading computation of opportunity cost. Under that, A, when material is scarce. Okay, when material is scarce, what is the standard quantity? Standard quantity is how much? We have already computed standard quantity. Where is that? The standard quantity was how much? 18,000. Whereas how much did we actually consume? 20,000. Okay, and what is the available labor hours? Available labor hours is 20,000. Okay, am I right? Yes, 20,000. So standard is 18,000 minus 20,000. Standard quantity is 18,000 units, but actual quantity consumed 20,000 kg or consumed. So excess consumed 2,000 units. Okay, now standard quantity of materials required for output. For producing one output, how much standard quantity is required? Standard quantity, the information was how much? 10 kg. 10 kg per unit. This also I can make it kg, kg and kg. Therefore, standard quantity of output that could not be produced, due to excess consumption of what? Consumption of material. What is the excess consumption? 2000 kg, and each unit of output required 10 kg. So how much? 200 units. Therefore, sales quantity foregone due to material variance. How much? 200 units. Therefore, contribution foregone is equal to, this is 200, not 2200. Okay. So 200 units multiplied by rupees 80, that is equal to how much? 16,000 would be the amount, right? 16,000. And this is which? This is adverse because you have foregone contribution, so this is adverse. So what do you have to do? You have to add that here with the material usage variance. What is the normal material usage variance? It is 8,000 adverse plus opportunity cost, that is 16,000 adverse. That will give you 24,000 adverse. Similarly, in the case of sales, 16,000 is the 16,000 adverse is the sales volume minus 16,000. So balance is nil. Is it clear? Okay. Now similar calculation you have to do for labor. Okay. B, when labor is scarce. Okay, you have to see standard quantity required and actual quantity. Labor standard was how much? 16,000 divided by 2,000 into 1,800, that is 14,400. 14,400 and 14,800. Am I right? Okay. So labor hours consumed as 16,000. Actually, how much did you consume? Actually consumed 14,800. Okay, right. Now, so here the calculation will be labor is scarce. Standard quantity for actual production. How much? 14,400 hours. Then actual hours, actual quantity consumed, 14,800 hours. Therefore, variance hours or excess hours consumed, how much? 400 hours. Now, if you see the question, we know that for producing 1 unit you require 8 hours. Okay, number of hours, standard hours required for 1 unit production. How much? It is 8. Therefore, number of units that could not be produced, is equal to 400 divided by 8. 400 divided by 8 will be 50. 50 units. Therefore, contribution foregone. Contribution foregone from 50 units of sales lost, that is equal to 50 units into, what is the contribution per unit? 80. Okay, so 50 into 80 is how much? 4000. And is it favorable or adverse? Definitely adverse. Why adverse? Because there is contribution foregone, which is an adverse thing. Okay, so when you take it here, what you have to do? You have to minus it from sales variance. We have to add with labor efficiency variance. So here it will be 16,000 adverse minus 4,000 adverse. So this will be 12,000 adverse, and here 3,200 adverse plus 4,000 adverse. So total will be how much? 7,200 adverse. Is it clear? 7,200 adverse. So that is how you do the calculation of opportunity cost, and you do the variance calculation whenever there is a relevant cost analysis. Now you can take the total. Okay, when you take the total, how much you will get? Okay, here when you adjust this, you should get actual profit here as 83,600, here also 83,600, and here also 83,600. Okay, so I think now it is clear how you have to find out the opportunity cost in various analysis when there is scarce resources. Okay, whenever there is scarce resources, you have to find out what is the number of units of output, standard units of output, which you could not produce due to the excess consumption of that scarce resource. Okay, then find out what is the standard contribution that you forgone from that particular excess hours or excess inputs consumed. Okay, then that should be reduced from sales volume variance, and it should be added with what? That corresponding factor cost variance. Okay, right. Now there is one more sub question. Comment on the efficiency and responsibility of the sales manager for not using scarce resources. The question is very simple. You have to comment on the efficiency and responsibility of sales manager for not using this scarce resource. What could be the answer? The answer is very simple. The sales manager is not responsible. For what? For the usage of scarce resources. Okay, so you can write third one. Okay, in traditional variance, analysis, the contribution lost due to short production, due to inefficient management of scarce resources. The contribution lost due to short production due to inefficient management of scarce resources was considered as what? Sales volume variance. For any sales variance, who was held responsible? The sales manager is to be held responsible. Okay, however, efficient management of what? Scarce resources or limited factors is not the responsibility of sales manager. Okay, rather, you can continue, rather it is the responsibility of the concerned production manager, full stop, the concerned production manager. Therefore any contribution foregone due to short production, in bracket you can write as compared to budgeted production, due to short production on account of inefficient management of limiting factor, should not be assigned on the heads of the sales manager, Okay, full stop. You can write as next paragraph. The above anomaly is a shortcoming of the conventional variance analysis. Shortcoming of the conventional variance analysis. This anomaly can be corrected. How can it be corrected? Can be corrected by deploying relevant cost approach of variance analysis. For variance analysis. Okay, next paragraph. In relevant cost approach of variance analysis, any contribution foregone from the short production, due to excess consumption of scarce resource, is treated as the opportunity cost. Such opportunity costs are adjusted against the usage variance or efficiency variance, of the respective limiting factor, cost variance, comma, and not against the sales volume variance. Accordingly, this method correctly treats the opportunity cost on account of inefficient management of limiting factor. Is it clear? Okay. See, this is one comprehensive problem from relevant cost approach of variance analysis. In morning session, we have seen the theory part with respect to this, but we did not do any question there because there was no question in the material part or in the institute study material. But in the institute study material, your test exercise part, there is a question, and that is what we did now. Is it clear? Okay, right.